I'm going to give you the raw, unfiltered truth. Your portfolio is red. The news is screaming about crashes and recessions, and you feel that sick, gripping fear. But here's my immediate rule. Do not panic. Before you sell everything, close the app or start crying. Understand this. Historically, every major market crash has been the greatest wealth transfer event, creating countless new millionaires. This isn't a suggestion, it's an iron rule of finance. This could be your once-in-a-decade chance to get rich. So, how do you actually do it? We must first establish the facts. Why do markets crash? Is this chaos normal? How do the smart money players survive? And most importantly, how do some profit massively while the majority lose everything? I'm going to give you the blueprint. Rule 1. Understand the enemy, why markets crash. It's not random. To profit from a crash, you must first eliminate the fear of the unknown by understanding why these events occur. A market crash is simply a sudden, fast drop in stock prices, typically caused by three primary financial mechanisms. 1. The bubble burst. Hype meets reality. Stock prices become aggressively detached from real business value due to pure speculation. When investors realize this dangerous disconnect, they dump the overvalued stocks and prices crash violently. The dot-com disaster, early 2000s, is proof. Hype pushed the Nasdaq up 800%, but reality crushed it by nearly 80%. 2. Bad economic conditions and policy overreach. Crashes are frequently linked to fundamental economic problems. High inflation causes people to cut spending, leading to lower business profits and potential recessions. The central bank's move to raise interest rates to fight inflation also makes loans expensive, stifling businesses and causing policy-induced panic. 3. Black Swan events. The unexpected shocks. A black swan is an unexpected high-impact disaster like wars or pandemics. The 2018-20 COVID-19 crash is a recent example, where markets fell over 30% in weeks due to panic over a global shutdown. Rule 2. Stop freaking out. Crashes are normal, it's the cycle. The market does not just move up, it moves in cycles, ups and downs. If you're investing for the long term, you must accept that crashes are part of the mandatory cycle. History shows the market follows a predictable pattern. Pullbacks, 5%, 10% drop almost yearly. Corrections, 10% and 20% drop every 1 to 2 years. Bear markets, 20%, 40% drop every 5 to 6 years. And crashes, 40% or more drop, 10 to 20 years apart. History's undeniable lesson, the market always bounces back stronger. The losers were those who panicked and sold. The winners were those who stayed calm and bought strong stocks. You should only truly worry if the entire economic system breaks down, banks going bankrupt, country defaulting, but these situations are extremely rare. Rule 3. The Millionaire's Blueprint. How to profit from a crash. A market crash is the best. Opportunity to build massive long-term wealth. Remember Warren Buffett's famous decree, be greedy when others are fearful. Here's how you execute that strategy. Mistake 1. Panic selling, the real way to lose. You haven't lost a single dollar unless you sell. If you sell at a loss, that loss becomes permanent and real. The action, hold the line on quality stocks and focus entirely on the long-term potential. Mistake 2. Trying to time the bottom, it's a fool's game. You cannot predict the absolute lowest point. The action, ignore guessing. Use dollar cost averaging, DCA, by investing a fixed, consistent amount regularly. Mistake 3. Buying trash. Just because it's cheap, focus on quality. Not all companies recover. The action, focus only on strong, profitable companies with low debt and solid earnings. During a crash, great companies become cheap, not because they're bad, but because everyone else is panicking. The Amazon example shows investing at the 2008 bottom could have yielded over 8,000% growth. Mistake 4. Lack of diversification, putting all your money into one stock is gambling. The action, spread your risk across different sectors, tech, healthcare, and non-stock assets, bonds, ETFs, to balance losses. Mistake 5. Blind FOMO. Don't follow the herd. Never follow the crowd when panic spreads. The action. Do your own ruthless research. Never blindly follow anyone, not even the pros. As Warren Buffett commands, never invest in something you don't understand. The conclusion, a stock market crash feels terrifying, but it is just a cycle. The key to surviving and profiting is staying calm, avoiding panic selling, doing thorough research, and buying quality, profitable stocks at a deep discount. Panic sellers lose, but smart investors turn crashes into their biggest wins. The next crash is coming. Don't fear it. Be ready to get rich.